I'm delighted not to have two, but three industry experts with you this afternoon to help us set the scene for 2014 and to give us food for thought as we head out into those breakout sessions. Just coming onto stage, first up is Elizabeth Winkle, who's Managing Director for STR Global Limited and is based in London. Prior to being appointed Managing Director, Elizabeth had been Director of Operations for the company with responsibility for operational and client relation management there. Now, she's going to give us a view of an overview of global trends in the last year, a little bit of forecasting in terms of supply and demand, and with some emphasis on local trends in Europe. After that, Chris Day from Christie & Co. is going to remind us quite how far we've come over the last year, particularly in the transaction market, and is going to also give us some pointers for 2014. And Chris, as many of you will know, is Managing Director of Christie & Co. And has responsibility for 27 offices across Europe there, so he has got a pretty detailed insight into this. And rather intriguingly, his profile says he leads the team not only on advising high-profile corporate clients, but also on very discreet individuals focusing on the sector. But we're trusting you're going to be wildly indiscreet this afternoon, Chris. And then finally, as discreet as they come, is Michael Fishbin from the ever-diminishing Ernst & Young. When I joined, it was Ernst & Young. Is now went through E&Y, it's now EY. Any further, Michael, you just Y, I suppose will be the will be the question. And so discreet is Michael that he didn't even let himself know that he was appearing on this panel till Friday. So thank you for your preparation on the plane and over the weekend. Michael, by the way, is Ernst & Young's, or EY's, global and America's hospitality leader there. He focuses there on audit, tax, transactions, various things. He's going to give us a view, basically, on what's going on in the US capital market and how that's emerging out into Europe, particularly. And he's also going to talk about some of the customer trends, customer segments that are emerging there. Now, firstly, Elizabeth, could you just give us a few minutes on how you saw the world in 2013 and what you're expecting?
Yes. Thank you very much, Simon. Good afternoon. All right, I'm going to very briefly, I have about 10 minutes, I'll stick to that, to go over a bit of a global overview and then focus in on Europe and then talk about the outlook and the forecast that we see coming. And as you can probably tell by the accent, and for those of you who know me, I am American. I tend to run positive, so for those pessimists in the room, you might want to moderate some of what I'm saying just a bit. So looking back at 2013, overall, a solid year across all four regions. As many of you know, the UNWTO released their international arrival figures, showcasing that 1.1 billion international arrivals across the globe. Very, very positive results, up 5% from 2012, which was a record year as well. And we can see that translate into demand and into RevPAR growth across 3 of the 4 regions. We are seeing some slowdown in Asia. This is predominantly driven by our sample, which is a very strong sample in India as well as in China. And in China, we're seeing really 2 components of that slowdown. One is the significant supply growth over the past 4 and 5 years, as well as a general slowdown that we're seeing reflected in the general economy. When we look at the supply and demand balance across the sub-regions, so breaking the 4 regions into smaller regions, you can see very, very positive trends looking at, although there has been supply growth in each of the sub-regions, with the exception of Africa, we're seeing demand outpace supply growth. In Africa, to just provide a bit of color behind that, we do have a very strong sample in Egypt. Certainly we're seeing positive results in Nigeria, positive results in sub-Saharan Africa, but certainly the political instability and the challenges in Egypt are impacting the performance in Africa overall. I wanted to have a look at how Europe and the US have performed since the recovery or during the recovery. And so what I've done here is I have indexed RevPAR performance year in 2013 back to 2008. So the index is 1. And as you can see, going into the downturn in 2008, we actually started to see some softening, some cyclical downturn. So certainly, the global financial crisis had a huge impact on our industry, but didn't precipitate the downturn. It certainly accelerated it, it impacted it, but we started to see that downturn naturally occur going into 2008. I think what's interesting is the recovery starting at that bottom in 2009. We saw very strong recovery in both Europe and the US, but where the US has continued to grow and has actually exceeded the 2008 levels and even the 2007 levels on an index, from an index perspective, we have not actually passed one, or that index mark in Europe. And I know that Chris is going to speak to that from a transactional perspective as well. So there's still room to grow even to get back to where we were. On a positive note, however, we are seeing very strong demand. This is a rolling 12-month moving average looking at the demand trends in both the US and in Europe. And I think what's interesting is what's happening over the course of the last year. So you can see certainly that impact of the Euro crisis, some concerns about what was happening with the Eurozone. We saw declining demand in Europe, whereas the US continued to remain very steady. And now we're seeing that the US is stabilizing. From our forecast from our sister company STR, we're expecting performance to continue, but not to continue to grow in the US. It will still be very moderate, but we're not expecting significant performance going forward. It's just going to be average growth going forward. And the expectation is that Europe now has an opportunity to really grow in a way that we have not been able to grow yet. And we'll get into some of those numbers in just a second. So the first key theme for Europe is demand, demand, demand. We are seeing unprecedented demand in Europe. We are selling more rooms today than we have ever sold previously. And in this chart, we're actually looking at monthly performance, so month-on-month percent change. And as you can see from the title of this chart, the last 46 of the past 49 months have shown positive demand growth. So you can see the recovery coming out of 2008 into 2009, and then every subsequent month, we're actually building on the previous year, previous month demand. When you look at that on a rolling 12 basis, you can see the gray line is the change in demand, ending the year at positive 3.3% growth, and you can see that very nice continued growth coming out of 2013. We did see a bit of that dip that I mentioned into 2012 when we were concerned about the Euro crisis, and certainly had an impact with the austerity plans that were put into place by many European governments, less disposable spending, less activity from a holiday travel perspective, and certainly Europe is very intra-regional and a lot of the demand is very domestic. When you look at that long-term supply picture, very, very consistent with about 1% supply growth. And that I've got some further slides to show the pipeline going forward, but very consistent from a supply perspective. When you look at the same supply and demand trends across each of the classes, you can see that demand was not just filtering into the luxury segment or the economy segment. We were actually seeing very strong demand, that limited supply growth across all 6 of the classes that we track, and very, very positive in terms of a robust demand picture. So while I appreciate the economist's perspective and looking at the top percentage really contributing the most, we're actually seeing that demand go into each of the 6 classes. And again, supply is relatively muted across each of those segments as well. So now the question is, what do we do about rate? The only way really is up, let's hope. There's a question mark there. While this strong demand has translated into positive occupancy, you can see that for the yellow line with plus 2.4%, we're actually seeing a sacrifice in rate. So we're selling more rooms to more visitors at a lower rate than we have previously. And of those 1.1 billion travelers, over 563 million of them visited Europe, which was also a 5% increase on 2012. So we had an additional 29 million visitors to Europe in 2013 that did not visit in 2012. And we're still struggling from a pricing perspective, and we're struggling to yield. So the negative rate is actually having a very significant impact on RevPAR. I didn't really talk about European RevPAR in my very first slide, but while we saw the 5.3% increases in the US and we saw about 5% in Middle East and Africa, when it comes to European RevPAR, last year finished at just 1.7%. So while we saw occupancy gains, we did see the erosion of RevPAR by rate. And this is a little bit of a busy chart, but I'll just take a second to talk about this. So like we saw with the supply and demand, this is looking at each of the segments. And the blue bar represents the absolute occupancy achieved, and across the left-hand y-axis, you can see the absolute occupancy levels. You'll see that light blue bar that's actually showing you the occupancy growth year on year, and that yellow bar that's going across is referencing the right-hand x-axis, which is showing the ADR. And with the exception of luxury, which managed to stay absolutely flat year on year, every other class lost rate in its effort to grow occupancy. And the economy segment is something that's significantly pronounced. You're sitting at over 72% occupancy growth in excess of 4%, and rate declines of almost 2%. When we look across the 4 regions of Europe, we're seeing a very similar trend there as well, where we're seeing occupancy growth with ADR declines, with an exception of Southern Europe, where we are starting to see some really nice recovery in Greece, in Portugal, in many of the resort destinations in Spain. Barcelona continues to perform very well, and there are still a few markets that have an opportunity to continue to grow, but we are starting to see some of that recovery in Southern Europe that we had not seen in previous years. I thought this was quite interesting. This sort of speaks to that domestic demand, that intra-European demand. This is a graphic that I found on quartz.com, and it's based on European Commission data. And based on a European Commission survey, 92% of respondents who took a 4-day holiday or more in 2013 visited their home country or another European country. So from a domestic perspective, and particularly as it relates to regional hotels and provincial hotels, that demand is very much domestic and intra-European. So certainly the GDP trends that we're seeing and some of that positive news is going to have a significant impact. Gateway cities that are more exposed to international demand have continued to perform very well. Very limited pipeline going forward. We're looking at 143,000 rooms in the pipeline. This is a 3-year pipeline, so long-term average of an additional 1% per year for the next 3 years, in total 3% over the next 3 years, and a nice balance across all of the segments. Looking at the top 10 countries, UK, Russia, and Germany have the largest pipeline, with a smattering of additional European countries. We are starting to see, particularly in Eastern Europe and secondary cities, stronger pipelines develop, but it still really is the core 3 of Russia, UK, and Germany. When we look at the outlook, this is a chart that we do in conjunction with tourism economics. We overlay demand trends with their GDP forecast. And I think the positive note is that with a stronger GDP forecast going forward, we see that nice correlation between demand and GDP. And so the expectation is potentially that demand will continue to grow, especially now that we're seeing some restated forecasts and more positive GDP forecasts going forward. This is just a quick last year's actual performance for markets that we forecast. I know it's very busy, and really what it is an overall viewpoint for you to see that for the most part this was an occupancy story. Most of the growth that we saw was occupancy related, and as we forecast going into 2014, you can see that that picture changes slightly, where we're seeing both occupancy forecasted as well as ADR forecasted. So 2014 is really expected to be a story of ADR growth. And in summary, demand remains very strong, increasing international arrivals. We're seeing positive economic improvements across Europe. ADR, there hasn't been real rate recovery yet, and their opportunities certainly exist. Supply is limited across most markets, and we're also expecting ADR to lead that growth going forward.
Thank you, Elizabeth. What we're going to do is 2 quick more presentations, and then we're going to have a sort of Q&A session led by me. But Chris, do you want to come and talk about transactions?
Thank you, Simon. Thank you very much. Good afternoon, ladies and gentlemen. What I'd like to do in talking about transactions is take you back 7 years to IHIF 2007, when the hotel transactional market was on fire. Those of you who are old enough might remember that on New Year's Day 2007, 47 UK Marriott hotels were sold to a consortium of investors for 1.1 billion sterling. Jurys Inns was acquired later in the year for 792 million, and Blackstone acquired Hilton for 26 billion. Even as the financial crisis loomed, deals continued to happen throughout 2007 across Europe. In 2008, to all intents and purposes, the hotel transaction market ground to a halt, and it didn't improve in 2009. There was a glimmer of hope in 2010, but this was short-lived. Many transactions consummated between 2004 and 2007 were simply over-leveraged, and the downturn in values, in some cases more than 50%, meant that a significant number of individual hotels and portfolios fell under the control of the banks. It's well documented that banks across Europe have struggled over the last 6 years to re-gear their balance sheets. Nevertheless, 2013 marked the recovery in transactional volumes. Overall transactional volumes were some 50% plus ahead of 2012, and the market was bombarded with high-profile deals in the first quarter. You may remember Starwood Capital acquired Principal Hayley for a figure in the region of 400 million sterling. KSL Capital Partners purchased Malmaison and Hotel de Vannes for around 180 million. A consortium of investors led by Fatal Hotels acquired 20 Queen's Moat houses in Germany for a reported 250 million euros. That would have been a deal, wouldn't it? And to come full circle, and I think this is an interesting point, the 42 Marriott hotels sold in 2007 were sold out of administration to the Abu Dhabi Investment Authority for a reported 620 million, close to 400 million less than the sale price on New Year's Day 2007. The market was also surprised on the 6th of February 2013 when the board of IBRC was stood down by the Irish government and replaced by accountancy group KPMG. This had a significant impact on hotel debt, not just in Ireland but across Europe, and particularly in the UK. Eventually, huge bundles of debt were offered for sale comprising billions of euros, and many hotels were included in these tranches. Subsequent to this liquidation, debt packages were offered for sale by Lloyds Banking Group and others. One particular group offered by LBG was Project East, comprising solely hotel debt. And as we move into 2014, we're starting to see early signs that Spain is following Ireland. Sareb has been established, which is Spain's equivalent to NAMA, and we're seeing significant debt portfolios, including hotels, start to hit the market. Encouragingly, all this stock, whether assets or debt, is finding ready buyers with ample equity. Project East was sold to Cerberus and Deutsche Bank. Menzies Hotels, a provincial UK portfolio, was sold to Topland Group out of administration for a price well in excess of the guide of 80 million. And Blackstone acquired the former Concord Saint-Lazare for a reported 250 million euros. Meeting in Berlin in 2014, the hotel investment landscape is undoubtedly more upbeat. So what are we likely to see this year? Well, here in Germany, the Inter-hotel portfolio is likely to trade in the first half of the year. The De Vere Venues business in the UK is hotly tipped to go to Starwood Capital for a figure reputed to be in the region of 230 million, and Apollo are rumoured to be close to closing on SITQ for a rumoured price of 420 million. Continuing the debt sales story, Lone Star, Sankaty and Canyon Capital Advisors have won the battle for the 7 billion IBRC Rock and Salt portfolio, which includes Q Hotels and Puma in the UK. And we are likely to see further loan sales across Europe, but in particular in Spain. We're continuing to see interest in hotel investment gather momentum, particularly in core markets, including the UK, Germany and France. Since 2009, this interest has been focused on capital cities, mainly London and Paris. However, we're now seeing clear signs that this is spreading to regional cities and that the appetite for new development is also increasing. Interest in Ireland has almost been overwhelming, particularly in Dublin, as assets are released by the banks, and we're now starting to see the same rush towards Spain as debt packages are released. We're still seeing interest in other markets across Europe and the CEE, but this almost pales into insignificant compared to demand in the core markets. Investment in European hotel stock is still multifaceted. In virtually all processes, US private equity and debt funds are leading the charge. The main players will be familiar: Starwood Capital, TPG, KKR, KSL Capital Partners, Goldman's, Oaktree and Davidson Kempner, to name just a few. However, these funds don't have it all their own way. Active asset managers are encouraging bidders from a variety of sources, including sovereign wealth, high net worth individuals and family offices. And in a number of processes that we've run very recently, these private equity and debt funds are actually losing out to some of the later buyers that I mentioned. Real estate investors are also looking at our markets very closely. As yields compress in more recognized real estate sectors, innovative buyers are turning to the hotel sector to find real value. Perhaps not unsurprisingly, we have seen limited bidding from operators and brands. This is likely to change if non-branded product of quality comes to the market, or a branded portfolio capable of being absorbed by one of the major players to enhance their product range is offered for sale. A number of UK portfolios are about to come to the market, including the remainder of the UK Queen's Moat Houses portfolio. And my guess is there will be at least 3 more significant portfolios coming to the market in the UK over the next few months. There are also a number of interesting provincial assets currently in the market, including the De Vere Grand in Brighton and Sirocco Fortis Hotel in Manchester, the Lowry. Early indications suggest very competitive bidding for both of these assets. Across continental Europe, we've seen a number of landmark transactions recently, and we anticipate a steady flow of stock coming to the market during 2014. The market didn't reach the same dizzy heights as the UK in 2007, and consequently, other than in Spain and parts of Central and Eastern Europe, we don't anticipate the same volume of distressed disposals over coming months. We're currently enjoying a very active market where portfolios and high-value single assets are attracting incredibly competitive bidding. However, pricing is absolutely critical. If sellers become too ambitious, even in what appears to be an increasingly buoyant market, interest can dissipate very quickly and value will be destroyed. We've moved out of the dark days of 2009 when assets outside the heart of London or Paris were incredibly difficult to sell. Today, hotels located in regional cities across France, Germany and the UK are generating very serious interest. Spain is enjoying a renaissance similar to that experienced in Ireland over the last 12 months. Only tertiary locations remain really challenging. Debt availability is also playing an important part in this renaissance of demand across Europe. More and more banks are expressing a willingness to lend into the hotel market at sensible loan-to-value ratios. We're also seeing funds and insurance companies expressing an interest in entering the market to provide senior and mezzanine debt. Economic conditions are undoubtedly improving across much of Europe, but in particular in the UK. This will lead to improved trading performances in the hotels we are selling and valuing. This, allied to improving property values, creates a great opportunity for solid investment returns in the hotel sector over the next 5 years. It's very uneasy to understand why the hotel sector is regaining its investment appeal, as indeed evidenced by the number of attendees at IHIF this year. Thank you.
Chris, thank you very much indeed for that. And Michael, do you want to give us your view from the other side of the pond, as we call it?
At the end of each year, the global hospitality practice at E&Y sits down to reflect on the year that was and to debate and anticipate the topics that we believe will dominate the discussions in the boardroom in the year ahead. The outcome of these discussions are typically a top 10 list, and then we publish this list in our Global Hospitality Insights report. This year, there was considerably heightened level of passion and enthusiasm in our discussions, so much so that we added, for the same old price of for free, 4 additional thoughts. If you're interested, we have copies of our report available at our stand and also on our website. Looking back, following years of slow and stubborn recovery, the global hospitality sector entered 2013 with a strong appetite for growth. Building on the momentum gained in the prior year, renewed investor confidence and pent-up demand for trades all propelled growth within the global lodging sector and fueled an increase in transaction activity and worldwide improvement in hotel operations. This year, as we gather at the IHIF conference, we see a clear focus on growth, and I just wanted to touch on 3 topics that we cover in our report that I believe will dominate the discussions over the next few days, as well as in your boardrooms in the year ahead. In 2014, the investment and optimization of capital will remain top of mind for industry players. Investors will continue to gain access to a variety of capital sources across debt, equity, public, and private platforms. Acquisitions in gateway international cities will continue to remain top of mind for investors, but a renewed interest in secondary and resort markets is positioned to gain traction as well over the short term. Cross-border capital flows led by conglomerates, family businesses, and state-owned enterprises in the Middle East and Asia, along with the big real estate private equity shops, primarily originating from the US, are also anticipated to increase as international investors seek portfolio diversification in prime assets and stable economies. According to JLL, global hotel transaction volume reached nearly $47 billion in 2013 and is predicted to increase to $50 billion in 2014. According to Real Capital Analytics, hotel transaction volume in Europe has averaged between 9 and 11 billion per annum since 2009. This is well short of the volume that was achieved in 2007, which exceeded $20 billion. Investment from the US has consistently run at around 1.2 to 1.5 billion per annum over the time period, so this is about 15% of the total. All indications are that investment activity from the US, predominantly these larger private equity players, will increase noticeably in 2014, as well as in the years ahead. This investment activity will include both private equity firms with a track record in Europe, Chris mentioned many of them, as well as some new entrants. Significant equity has been raised and is ready to be invested, and there is a strong consensus that while pricing in the US is fairly full, confidence in Europe is greatly improved. In addition to the core markets, also Chris mentioned, UK, France, Germany, and other capital cities look for more attention to be focused in such countries as Spain and Ireland, as well as in secondary cities. A little bit about the customer. Self-assured, optimistic, globally connected, and curious. No, Simon, I'm not talking about you. The millennials are poised to take the hospitality industry by storm. A millennial, for those who don't know, or Gen Y, is anyone born between 1980 and 2000 in the US. This group makes up over 79 million people, and in the next 4 years, the millennials are projected to account for 50% of all employees worldwide. Fundamental characteristics and personas that typify millennials include speed demon, persistent autobiographer, undercover critic, cause activist, social being, curious explorer, spontaneous decision maker, and smart spender. Hoteliers must continue to focus on winning this vital segment by building trusted relationships, connecting with a purpose, recognizing the importance of experience, adopting an adaptive cross-industry perspective, and integrating new technologies and enhancing social presence. A second group to focus on is the Chinese traveler. China's outbound tourism industry has grown exponentially in recent years. As discretionary income levels among the rising middle class has increased, visa policies around the world have eased, and the proliferation of information on outbound travel has heightened the desire to travel abroad. Data from the National Bureau of Statistics for China indicated that outbound travel increased at a compound annual growth of 18.5% between 2000 and 2010, from approximately 10.5 million to 57.4 million travelers. Fueled by an increase in discretionary income and relaxed visa restrictions from popular tourist destinations, supported an increase to 83 million international travelers in 2012. And this number is estimated to increase to 200 million Chinese residents traveling outside the mainland by 2020. Globally, hoteliers must continue to adapt by understanding preferences by travelers from China, including language, amenities and services, and brand recognition. For many destinations, tourism sits at the core of the region's economy, acting as an engine for job creation and economic growth. In the years following the global economic recession, tourism destinations are once again evaluating their strategies for promoting visitation, maximizing a renewed interest in both business and leisure travel. To capture the demand of new and repeat travelers, destinations must effectively implement their tourism strategy, as well as support the necessary public infrastructure to ensure visitation of future travelers. Amongst the tourism agenda in 2014, look for further investment in airport and rail projects, direct marketing organizations, DMOs, turning to private sector hospitality leaders rather than government officials to implement their strategy, and finally, an acceleration of new development around the globe, ranging from luxury to hostels, all-inclusives to select service. Thank you.
Thank you very much indeed, Michael. Now, we've been held our feet to the fire in terms of timing. So what I've got is a question for each of you individually, then I've got a question for all of you to answer. Elizabeth, if I can start with you, please. I just spotted on your slide that in 2013, I think you said no city saw a rate rise without a rise in occupancy. No city, every class of hotel lost rate to grow occupancy, I think was what you actually said within that. And also as well, no city that I saw in 2013 saw a rate rise without a rise in occupancy, if that makes sense. Yes. And I noticed that Brussels, Amsterdam, Moscow, Hong Kong, Singapore, and rather bizarrely Leeds, I think was on there. But in 2014, you seem to be predicting that 8 cities should be. I mean, are you expecting that those cities will be full? Are you expecting that they're at maximum occupancy now and they can get rate back up again?
I think what we typically see with the data is that occupancy leads rate by about 6 to 9 months. And typically what that is as you start building your base, confidence returns to revenue managers and yield managers. And so pricing power typically returns. And so the expectation would be that on the back of the occupancy growth in 2013, some of it was probably excessive growth. Some of the occupancy levels that we've seen, you probably could have balanced out occupancy and actually driven rate harder and perhaps sacrificed occupancy. And the expectation is that in 2014 we will see more of that as there's more confidence in terms of how to yield more effectively, and pricing power will hopefully at that point return. What we see from long-term trends looking at US markets where we can go back almost 30 years of data, when a market is sitting at 62% occupancy, what that indicates is that you have multiple sellout nights over the course of a month. The booking window tends to expand because as people are trying to book in, potentially they're unable to book into their primary hotel, and you start to see additional lead time and pricing power tends to be able to be executed. Whether or not that will happen now still remains to be seen, but if we don't start to price more effectively in 2014, my concern is that we've missed the opportunity. It's now or never.
And, sorry, as a supplementary, I noticed as well that luxury seems to be growing supply more than budget. Can that be right?
Not as a percentage of
Yeah.
the total.
But in terms of compared to demand, I mean, the supply in luxury is growing faster.
It is, yes.
And why is that?
I think with in many of the markets, as we're looking at some of the new international visitors, there is a greater demand for a luxury product. And I think possibly as well that the budget segment historically, because it relied much more on the domestic demand, over the past 5 and 6 years, it has not performed as well. So we have not seen as much interest from an investment perspective and a development perspective. I think that's shifting as well when we look at the pipeline, however.
Brilliant, thank you. Chris, you mentioned obviously a sort of history of IHIF since 2007. In 2010, I remember a lot of people raising funds, having opportunistic strategies. Everyone's going to buy these hotels really cheaply from the banks, and they've been sitting there with that money for perhaps 3 or 4 years. What went wrong with that as a strategy?
Our experience with the banks was that they didn't feel that the prices they could achieve in 2010 was sufficiently attractive for them to be sellers. So consequently, they held the portfolios for another 3 and in some cases 4 years. And it's quite interesting, actually. I think if some of that stock had been released in 2010, you'd have seen higher prices than we're currently seeing now. Because of the pent-up demand that was there, but no stock was released to satisfy it. So it's basically the banks looking at where deals were struck in 2007, looking at prices in 2010 and saying we're going to hold because we'll get back to 2007 in another 3 years' time. And of course the market has been static at best.
Excellent, thank you. And Michael, here's a dilemma I'd like you to resolve for me. US funds, you mentioned, have raised loads and loads of money, and they've got to spend it. I think that's certainly the case, and Mrs. Johnson's getting killed on her management fees, but they're sitting there doing nothing with it. Gilt rates in the States are 2.6%, in Germany they're 1.6%, but sovereign wealth funds have also targeted the sectors. Is it really the case that the US funds can get their heads around European assets and buy them at the kind of rates that they're being sold at?
Yeah, and I think for especially the big private equity funds, the focus is on portfolios and larger platforms, operating platforms that they can build off of. Different than I think what we're seeing perhaps from the Middle East, trophy assets, larger assets. So I think there needs to be a growth story and a view that through the portfolio or through the operating platform, that opportunity will evolve.
Right, and so you think they're not going to be competing, or they are going to be competing, but on very competitive terms?
I think they'll need to see a story on a specific asset, just on a one-on-one. I don't think they'll necessarily win out in those situations.
Okay, one final question, because our time is up, but for each of you, I'm going to hold you to this. I'm going to make my little notes within this. What one single specific prediction that we can hold your feet to the fire on would you make for 2014? Chris, we'll start with you.
We'll see yield compression.
Where?
On hotel.
That's not specific, that's general. You'll be able to find an example next year.
I think in the core markets we've been talking about, I would anticipate prices increasing by between 10 and 15%.
And single assets or portfolios, or both?
I think both. There's the demand that's there is going to lead to reasonably chunky price increases, I think, over the next 12 months.
Yeah. Michael?
I was going to say that the United States will not win the World Cup, but I'm not sure if that's what you were looking for. I think we're ripe for some larger M&A this year. You know, the
specifically?
Talk to you later.
No.
That's for these guys to work out, but the capital is there. Certainly the macroeconomic landscape is very positive. There is a clear focus on growth, so I think there's a lot of ingredients.
So one of the big names will be taken over?
I think we'll see some larger M&A.
A US-based firm?
Next question. We're running out of time.
Elizabeth?
I think From a performance perspective, we expect, and what I would say is that from a RevPAR perspective, rate will contribute more than occupancy for RevPAR growth in 2014, and we'll also see better yields from a GOP perspective because we're seeing expenses cut as trimmed as they can possibly be, with the exception of some of the staffing and payroll costs that have been going up, so any revenue increases are going to hit the bottom line.
And do you think that this millennial customer that likes checking in automatically, reviews it privately, books later, whatever else it might be, is that going to benefit the hotels in terms of GOP?
Not specifically that, but I think you also have the baby boomers and you have other demand segments within from a demographic perspective. I don't think we're really going to see the full impact of the millennials this year. I think going forward in the second half of this decade, much more significantly. So I think for 2014, I'll keep my forecast very short and sweet.
Brilliant. Ladies and gentlemen, thank you very much indeed.